Hello and welcome to the Encounter Hedge series. Welcome to the Encounter Capital YouTube channel as well. So mortgage pain. Hundreds of millions of homeowners around the world are on flexible interest rate mortgages. Less so in the US, but globally it's a huge issue. And also millions and millions of businesses around the world are paying a lot for their debt. So which way are interest rates going to go? Now, the US interest rates impact the whole world. So let's focus on the US and what's happening there. Donald Trump wants interest rates to fall. It will reduce the interest rate payments on US debt, and it will help the competitiveness of US companies, and it will help US consumers to be able to spend more. Jerome Powell has been pushing back against Donald Trump, the Fed chair. He doesn't want to reduce interest rates, or not quickly, because it can increase inflation and decrease the stability of the US economy. So the next guy in, probably in May 2026, probably will be Kevin Hassett. And he seems to be saying the data all points to the fact that US interest rates should fall. So it looks like interest rates will go down. Traders' consensus opinion over the next couple of years is that interest rates will be in the threes. Not that they'll fall to the 1% that younger people are used to. No, the long-term average, long-term normal is around 3, and it looks like that could be where we're at in the next couple of years. Another point on why interest rates will fall is that it's a geopolitical sensitivity. The US needs its companies to be competitive. When those companies are borrowing at high rates, they can't be as competitive. They can't grow as easily. They can't offer discounts or freebies to their clients. It's really important for the US growth to have cheaper debt. And that's why it seems that the Fed will take that risk of inflation to lower interest rates. On the other side of the equation, we could say, no, interest rates aren't likely to fall. Why? Because the Federal Reserve of San Francisco has done research that says longer term tariffs cause inflation. Obviously, tariffs increase the price of goods to the end consumer, and that feeds through longer term to ongoing inflation. Ongoing inflation is a key data point that will reduce the likelihood of interest rates falling. And a second point is that there's a balancing act for the consumer. As interest rates fall and inflation can rise, consumers are very, very sensitive to this. They feel less confident. They go and spend less, which will slow down the US economy. In summary, I'd say consensus opinion is interest rates over the next couple of years will be in the threes. It'll reduce the pain of mortgage holders and reduce the pain for business owners trying to leverage their companies up. We're unlikely to come to that 1% flat interest rate environment, especially in the US. But I think things will ease. Things are expected to ease. And really, it comes down to the fact that that's because President Trump wants them to ease. He seems to be having more and more impact on these decisions, which are not meant to be so politically decided, guided, but with Kevin Hassett coming in and seeming to be aligned with the president, I think interest rates will drift lower. Thank you very much for listening to this more technical discussion, a huge discussion. Please comment below and please subscribe to our channel.